All right, good morning, everybody. Welcome to this week's client support webinar. My name is Bennett McDowell with TradersCoach.com. Great to have you here. All right, a couple announcements here. One thing we wanted to tell you is that we are looking at trying to put together our annual in-person tutorial. It'll be held in the Tucson area, and the weather's going to be beautiful when we do it. It looks like we're going to probably do it January, February-ish. So the weather absolutely be ideal here. And we'll let you know. We'll send you an email out. Gene's putting all that together. But it's a great time for me to actually meet you in person. It's also a great time for you to sit back and have an actual one-on-one with me as we go over the concepts. We look at live markets as well. And so, you know, you kind of lose that a little bit with all the technology today. We're all kind of far removed. So we find these in-person summits that we call them, or tutorials, really great. They do sell out pretty quick because we do cap it, but we'll get everybody a fair chance to get in and attend as soon as we get the dates squared away. So just kind of wanted to go over that. All right, so let's go ahead and go through our administrational items. Of course, we have to explain the risks involved in trading the financial markets. And like I always say, without that risk, there is no opportunity. So the two really go hand in hand. But you need to be aware of the risks, and also please trade with money you can afford to risk, called risk capital. And as you know, because many of you take our courses, use our software out there, you know that we are very big on calculating the proper trade size or position size on each and every trade. That's really important. And if you need any additional help on that, you know, I've got books and so forth, and you can definitely check those out. All right, so that's important. A lot of what I talk about here are based on my analytics, my testing, my opinions on the market and so forth based off my analysis. And so please realize that if I recommend anything, run those recommendations by your financial advisor or whoever manages your money to be sure they're suitable for you. That's really important. And again, always trade with risk capital and realize we deal in a realm of probabilities, not certainties in the market. All right, so here are my books. I'm not going to elaborate too much on that because many of you are returning customers and clients, and so therefore you already know this. Same thing with the software. That's out there as well for everybody. Now, today I've gotten a lot of emails on how the pyramids are drawn. Now, if you remember last week, we talked about the art reversals and the color bars. So we're specifically dealing with this package here, and this is called the art software. And this software draws the pyramids on the chart based off patterns, so it's pattern recognition. It also draws art reversals, which are our key pivot points, and we use those for scalping or even trading channeled markets. And then it also draws the color bars differently than a standard software package. So I covered last week the color bars and the art reversals. So today we're going to focus on the art software pyramids. And of course, if you have any questions on anything, feel free to always ask, and it doesn't have to be necessarily related to the topics we're covering. All right, so when we talk about pyramids, this is TradeStation. Here they are here. Okay, there's bearish ones and bullish ones, and they occur on all time frames in all markets. Here it is on NinjaTrader, same thing. So we're going to discuss what goes in to the determination of both bullish and bearish pyramids and the different kinds. You know, we have a P, all right, these are Ps, but we also have these MPs down here. So you see we have two different types. And then we're going to throw also in the unconfirmed pyramids, which are drawn usually as a yellow by default. I have them drawn here as a blue, simply because it's easier to see on a webinar. All right, so we're going to discuss the pyramids in great detail. And for that, I'm going to bring up a whiteboard and go over a couple things. Now, first thing I want everybody to, I'm going to ask everybody, what's the definition of an uptrend? And then tell me also after that, we're going to discuss downtrends. But first, what's the definition of an uptrend? Very simple question. If you open any trading book, you'll see that as pretty much the same definition across the board. Right, higher highs and higher lows. That's good, Jeff. Excellent. Okay, so that's correct. So when we look at patterns, what's a higher high and higher low? Well, it's when you have a low here. We'll call this low 1. This is a low 2, high 1. And then with this, as soon as it breaks above here, becomes a high 2, right? So there's your lower highs and higher highs and higher lows, rather. Okay, that's the definition of an uptrend. Now, on a downtrend, it's the reverse. Okay, so we have right here low 1, all right, low 2, or high 1, I should say, and high 2, low 1, and low 2. So the definition of a downtrend is lower lows and lower highs. And of course, that's what this is telling you. And so therefore, when we breach this low 1, this becomes the new low 2, and that completes the definition. So you have this definition that is suitable for both up and down trends. Now, that became very important when we designed the ART software, because one of the key things we wanted to do is we wanted to identify the trend. And the simplest way to do that is using the higher highs, higher lows, and vice versa. So when you have a situation where that occurs or is about to occur, you get a little bit of a pocket here. So this is your low 1, this is your low 2, this is your high 1, and now we're waiting for a high 2, right? And so the software looks for these types of configurations. So whenever the market is unfolding in real time, all right, it's looking for these little pockets. And of course, if the pocket is justifiable, it will draw in the triangle like here, okay? So the triangle is nothing more than an icon that I thought when I was designing the software would be easy for everybody to see and identify. All right, so let me erase this again and go back to our higher highs and higher lows example. So what happens is when the software thinks that, okay, this may be, not sure, this may be a pyramid in here, okay? So after it looks at the price pattern, there's a couple things going on behind the scenes that you need to be aware of. It's looking at the momentum on the way up on the left-hand side of the triangle, not the volume, but the momentum. Now, can anybody give me a definition of momentum? I'll put M for momentum there. Anybody give me a definition of momentum? And I imagine those that you have been with me for a while know this. And okay, here it comes. All right, right. So everybody's typing in. All right, so it's how fast prices are moving, right? All right, now momentum can be quite high, even if volume is low. Why is that? How could you have momentum high, even if volume is low? You have to have an existence of volume. There has to be some trading, but the volume can be low with momentum being high. How can that happen? Anybody? Well, the reason is it depends on how many buyers there are versus sellers and vice versa, right? So if everybody is buying and nobody is selling, well, the momentum is going to increase price, even though there may not be really a lot of volume. You have to have some volume, don't get me wrong, but the volume doesn't have to be heavy. And the reason I designed the software not to look at volume specifically is because a lot of times trends can start on fairly low volume. And the reason for that is that if you're coming off a bottom and you're starting to move up, people may not realize that there's an opportunity here yet. And so volume is low. But momentum could be high, which is causing the surge in prices. And the momentum can be the result of anything. It can be the result of a news event. It can be the result of just, people going in the opposite direction of the new direction, covering their trades, right? Profit taking, so to speak, okay? All right, Elliott wave counts, okay? Could generate some movement off a bottom. So there's many forms of technical analysis that people use that can generate that. And that's really not important because all we really care about is what the momentum is, regardless of what's creating it. So that first leg up, the software is actually looking at the momentum from the low one. And if we get a high and then we get a reversal, all right, then this momentum has a value that the software looks at. The next thing the software does is say, okay, so now we're pulling back a little bit. Let's see how far and how significant we pull back. So once again, it's looking at the momentum on the pullback. And again, the secret sauce of the pyramids forming has to do with the secret sauce of the momentum calculations. So it's looking at it then. Then if we get another pivot and turn in the market, it's looking at it again, the momentum. So it's looking at the momentum on all sides of the triangle, not the bottom, okay, just the sides. Now, what will happen is after the third price bar, this is important, after the third price bar off the bottom of the pullback, which is represented by L2, the software has to make a determination at this point. Is it going to draw or is it going to pass? So basically that determination is made based on the momentum calculations. If it decides that there's potential here for a good trade or a good pyramid to draw, it will go ahead and draw it in. And the color of this will be yellow by default, but you can change the color. Okay, sometimes I have blue on my charts. So at this particular point, we have a situation where we have what we call a potential pyramid or an unconfirmed pyramid. Okay, and this unconfirmed pyramid will result in two outcomes. It'll either be confirmed or voided out. Okay, and it will stay unconfirmed until one of these decisions is made. Does anybody know, and they should, what those decisions, what is a confirmed pyramid and what is a voided pyramid? Anybody? What's a confirmed pyramid? Right, prices go over the top, right? So if prices continue on up, let me just erase this a little bit here. So if prices continue on up and go above high one, which is the apex or top of the pyramid, the point, then this will become a confirmed pyramid. Okay, that will become a confirmed pyramid. And obviously it will draw P under here and it will turn green, okay, at this point. Okay, so it'll go from yellow or whatever color you have designated for an unconfirmed pyramid, it will change from that color to a green. And you've met the definition at that point because high 2 now is high 2. It's gone above high 1. All right, and very basically what the pyramid has done is done a couple things for you. It's taken a look at the pattern, which creates higher highs and higher lows. It's looked at the momentum that went into that pattern, and when they both solidify, it will then create the pyramid. But it has to go above, prices have to go above high 1 in order for the pyramid to be confirmed. Now, let's take another scenario now and say, okay, well, what if it's voided? Okay, so let's take a look and see what could happen with that. Let's erase this here a little bit. So let's say we have prices that went up a little bit off its bottom, and so a yellow pyramid formed. I'll put a question mark in there for unconfirmed. But instead of taking out the high, prices decide to go back down and go below the low too. This pyramid is going to go away at that point because it's voided. All right, and then it will have to look for another sequence for it to start all over. Okay. Frank, I see your question. I'll get to that in a minute. All right, so that's kind of an important aspect to realize what confirms and what voids a pyramid. Now, just to throw a little bit of here, since this, I'm going to leave this drawing like this. Let me just clean it up a little bit here, okay? And one of the things I want you to be aware of is you can have a pyramid here, unconfirmed, and guess what? You can also have one pointing down, unconfirmed. How many people have experienced two yellow side-by-side pyramids, one pointing up and one pointing down? Right, a lot, right? Okay, you see that? You see that, and you usually see that when markets are drifting sideways or, like Frank says, in consolidation. All right, so the neat thing about this is when this happens, the pyramids have automatically isolated the channel for you. And if the market breaks down, then this pyramid pointing down will be confirmed and this one pointing up will be voided, vice versa. If we go down and go back up, all right, this one will be voided and this one will be confirmed. So it's kind of cool, all right? So that's the deal. All right, let me erase this now so we can clear it up. Any questions on that right now? Any questions? You just let me know if there is. All right, so the next thing is that, and Frank asked a very good question, does the size of the pyramid make a difference? You know, there's a big pyramid, but what if we have a little one? Okay. In terms of how we use them, the answer is no. You know, large or small, both the same, okay? So that's kind of easy. But you usually see this in a faster market. But let's talk about this, okay? This makes sense, right? Less of a pullback, it keeps surging forward. However, this is still as powerful as this, simply because look how much higher prices have to rise in order to take out that point of the pyramid and make the higher high, right? So there had to be a lot of power in this run for that to happen. And on this run, there had to be a fairly fast and powerful market to make that happen. So both pyramids, because of the way in which they form, all right, are to be looked at equally. The only difference, you know, in terms of trading, the only difference is you're going to see the smaller ones, chances are, in faster markets. Not always, but usually. Okay. So hopefully that answers your question. So treat them both important. Now, with that said, okay, you usually see this in the beginning of a trend, and you see this once the trend is taken off, okay? So this you see more in a wave 3. This will see like a 1, maybe a 2, or something like that. Because that 2 can create a big pullback, right? Okay, so that is a very good question, and hopefully I answered that okay. Now, one more thing. If you have to realize the way the pyramids were designed, they were designed independently. So basically, they act on their own accord. They are not looking at a target, okay? That you have to devise with another method, okay? They are only looking at the price pattern and telling you what is going on in the here and now. So if you, like Elliott wave, for example, and you think you've had a big move down and you're at wave 5, and now you're getting ready for a big move up, all right, let's just accentuate this. So that would be wave 1 of the new move up, okay, wave 2, and wave 2 can retrace all the way, and then you have wave 3, right? So if you get any pyramids forming in here, okay, or you get one, you may not get any. You might not get any until you get into wave 3. Depends on the market and how much it pulls back on wave 1, etc. But you have to realize that the pyramids are looking only at the current trend it's in. So wave 1 is a trend. Wave 2 is a different trend. And then wave 3 is even a different trend there. Okay, so if you're planning on reaching a target, let's say you're using Elliott wave and the target is way up here, I tell people do not use the pyramids for stops, and I'll cover stops in just a minute. Instead, base your stops more on the Elliott wave until you decide what wave you want to exit. A lot of people like to exit at the end of wave 3, so you'd use the pyramids here, okay? If you're trying to get all the way up here, well, then you better be careful on which pyramids you use because you have wave 4. So your pyramids have to be below, I would say, 61.8%. Does that make sense? So deciding on if you're trading the current trend in an Elliott wave will determine on which pyramid you use for exiting. And let's talk about exiting because I haven't talked about that. So one of the nice things about the pyramids are the idea behind them is that when they form, they give you quite a bit of information. A, where you're going to enter, right? And your stops, your stop loss. Now, what we recommend is putting your stop under the bottom of the pyramid, whether you use 1 tick or you have been trading a market and it's, you know, you found that it's better to give that market more ticks, that's fine. But that's where the stop area should be considered, okay? And if you think about that, it makes sense because this is a pivot at the bottom here. This is a resistance here, right? So it kind of takes into account, the pattern takes into account the volatility. The volatility is great, like Frank was saying, you'll get a big pyramid, so you need to have that stop far away. If the volatility is not so great, like in a wave 3, then you can put that stop pretty close, okay? So the pyramids kind of do a cool thing. They kind of look at the volatility of the current situation and help you determine the best part to put your stop based on that trend, okay? Now, when a new pyramid forms, let's get this out. When a new pyramid forms, like in this case, let's say we have a bullish pyramid here. And, you know, in order, you know, the points of the pyramid will always face in the direction of the trend, okay? Because that's the way they're designed. The base leg always indicates the stop. We call this the apex, okay? And the bottom or flat part of the triangle is the base leg, okay? Just to get the labeling correct. So the idea is that if you enter initially here, okay, because this is your higher high going over the apex, your initial stop will be here. But when a new pyramid is forming and you're trading the trend itself, you would move the stop up under the pyramid. That's how you trail your stops. Now, probably about 20 years ago, maybe 25, time's going so quick, I did a complete comparison between setting stops this way and using a moving average. And I used the moving average system. And basically what I found with a moving average is that if you have a moving average in place, I was getting stopped out of good trends way too often. So I found stops under the support levels work a lot better. And you can test it yourself and see. And some people will say, oh, well, you know, you didn't use the right moving average number. Okay, well, they constantly are tweaking it to fit their point or paradigm, okay? So that becomes another subjective situation in setting stops. So I like to do it hard and fast under the pyramids. And with the exception of, like I told you before, if I'm using Elliott wave and I'm trying to get here, all right, then you're not going to want to use the closest pyramids all the time. You have to account for where the fib retracements are for the best pyramid to use, which would be under here, okay? Does that make sense? All right, one last thing, and then that kind of will be it for today. So the other thing too is we have two types of pyramids. We have the standard P pyramid, but then we have something called an MP, which stands for minor pyramids. Now, a minor pyramid will always be in the opposite direction, always point in the opposite direction of the P pyramid, whether it's a bullish or bearish trend. And they're designed like that because what they're really indicating is that we're in a correction against the P pyramid. So the P pyramid, you can think of when you see the word P, not only is it stand for pyramid, but think of it as the primary pyramid or primary trend. So a P pyramid will always indicate the primary trend, whereas MPs are indicating corrections in that primary trend. So for example, if we had a move up here like this, and then we had a move down here and a pyramid formed here, this would be an MP. Okay, because, and think about it, if you were long here and your stop was here, you're still long, even though this forms. So what's the purpose of that? Why do we have that in there? Well, one, it alerts you that we're in a profit-taking correction, okay? The other thing too is you can use these for scaling out. I mean, if it goes below the P pyramid here, you can scale out there, okay? Or not. A lot of times when that happens, what happens is you get something like this. You might even get another one. And then it reverses, gives you another one here, and then you move your stop up here, okay? That type of thing, okay? So that kind of is the difference between an MP or a P. So for an MP not to be an MP, okay, this is a P. Let's say we have something moving down here. This is going to be an MP, remember? And let's say the market breaks down and forms another one here. Is this going to be a P or an MP? Correct. That's going to be a P. And the reason is because the point of the pyramid now is below the base leg of the original or other P. And so therefore you would have been stopped out of your long trade and this would be now a short trade, so to speak, okay? So when the points of the pyramids go below the opposite pyramid that is a primary, then it is a new P to the downside, or vice versa, okay? All right, so that's kind of important to know. Now, a couple other things, and here's another question Frank was asking. Consecutive pyramids. So there are times, there's always exceptions and rules, okay? There are times when we have, let's say, a big Elliott wave 3, and we're getting all these pyramids up here, right? So we got one here, one here, one here, one here, and one here. So all P's, right? Stop, initial stop here, then we trail the stops up here. Stop is here. And we get to the top here, and we get an MP. Okay, well, usually after 5 consecutive P's in a row, and we had 5 here, right? If you wanted to go short, exit your long here, and do a stop and reverse and go short here on this MP, that is a exception rule where you could do that, because what we've noticed, when you get that many pyramids in a row, like the 5, then the chances are you're due for a change or major correction, okay? And you see that on the wave 3s a lot, okay? You don't have to take the P pyramid, because you could wait for this one to be stopped out and for a new one to form. That's okay too. But this just gives you another exception, okay? Possibility. Now also too, another thing to talk about, and this is going to be the last thing because I don't want to go over too much here, but when we move up, all right, and we go in here, right, long entry here, and we have another one that forms here, okay, both P's. Your stop is here initially, right? So we'll call that the initial stop. We'll call this the trailing stop. So if our stop is here and we entered here, do we have any risk on the first trade? Do we have any risk on the first trade? No, right? Because if we get stopped out on that second pyramid, that's a profitable trade because we got in here, right? So if this is your second pyramid and this is your first one of the rules is that when the second one forms, as long as you move your stop and eliminate the risk from the first trade, you can add on. Do your trade size again, but add on. You can add on to the trade. And this is a smart way to do it because you're increasing your trade size or position size without taking any additional risk that you wanted to take initially when you took the trade. So if you had a 2% risk here, well, that 2% is eliminated. You probably even made money now on that first one, right? Probably even made 2%. So if you took another 2% here, all right, if this is that profitable compared to the first one, then if this gets stopped out, you're going to lose 2, right? And you made 2. So you'd be flat. So that's the proper way to increase trade size without increasing your risk. All right, I think that's it. All right, so that gives you, unless I missed anything, and if I do, please let me know. But that's what the pyramids are all about. Thank you, Frank. All right, so I recorded this, and the recording is going to go in our usual spot, so you can review it. But I think that gives you the information you need to understand the pyramids, how they form using momentum, and the reason behind using momentum, and also too, the sizes of the pyramids and also the unconfirmed pyramids along with the minor pyramids. All right, so we'll end here today, okay? So that's it, and I'll see you back here next week, and you guys have a great week, and thank you for coming. Good turnout today. All right, take care, everybody. We'll see you next week. My pleasure.